Swayam Prabha. Digital India. Educated India.
Let's summarize what we did yesterday. I tried to define money, and I said that it looks like the most narrow definition of money is currency that you see, most narrow definition of money. Currency, which are notes and coins, but if you look around, given the banking systems we have, one can easily open a savings account and can write a check in the morning and withdraw money, or they can withdraw these days from automatic teller machines. So, need not be cash with people or currency, but even some accounts in banks which has checking facility is part of your money. So, money can have a narrow, wide, all sorts of definitions. We will come to that later. The question that arises, most important question that arises is money part of wealth? We said yes. Wealth is a broader item which contains money and non-money assets. Then, why do we need money is a more important question, and I said the oldest function or utility of money, the oldest function or utility of money that you have is that money serves as a medium of exchange. Because as a medium of exchange, if you have a common unit in a country, it helps you out in many ways. A few examples I gave you. One, if you have a barter system where people exchange goods against goods or goods against services, you have multiple exchange rates which are difficult to remember. Like one pair of shoe is equal to 2 shirts, one pair of shoe is equal to 3 kgs of wheat, one pair of shoe is equal to half a semester classes, whatever. It's very difficult to remember that. Whereas if you have money, you simply remember the price in money terms. And also it reduces the number of prices, which I called exchange rates, are relative prices. Price of shirt in terms of shoe, price of lectures in terms of shirts, whatever. These are relative prices. The prices become simpler, and I give you an example that suppose you have 4 items, then there will be at least 6 relative prices in a barter system, but in a monetary system where you have money, there will be 4 prices, 4 items, 4 prices, which are sold in the market. So, it does simplify, but to serve as a medium of exchange effectively, which has evolved over time, economists, kings, emperors, etc., who discovered and used money or made money popular or compulsory, realized that money need to have certain properties in order to serve as an effective medium of exchange. Number one, it must be standardized so that there is no confusion, the money you have is different from the money I have. It must be widely accepted, people should accept money. It must be divisible so that you can make small exchanges where part of a money is required, a unit say 100 rupees is not required but 25 rupees required, or say 20 rupees not required but 12 rupees required. So, money must be divisible. You are not forced to buy a fixed amount, you can buy any amount. So, money must be divisible. Money must be easy to carry. I gave you the example that imagine a housewife going to the vegetable market with a porter carrying a basket full of money on his head. It's so heavy. It cannot be like that. Money should be easy to carry, and it must not deteriorate quickly, because if money deteriorates quickly, whatever form it is, paper money or metallic money, whatever, then it's very difficult to find out, as people can lose confidence. अरे ये सही नोट है क्योंकि दिखाई नहीं दे रहा है क्या printed है. So, money must not deteriorate. It must have a good quality so that it lasts, and if it does deteriorate, then the central bank, who is the issuer of money in every country, must be willing to withdraw it, replace it with new money. Then I said there are two more functions of money which have developed. One is a unit of account, which is very important. In an accounting system, you can keep accounts in terms of money. So much expenses in rupees, so much income in rupees, so much I borrowed from you in rupees, so which I have to repay, so much interest I have to pay to the bank. Accounting systems, money can be used. It's good if you have money. And also finally the store of value function. You can use money to store value the way you use jewelry, gold, silver, other precious metals, property, shares, bonds, fixed deposits to store value which you can use later. Money can be used to store value. So, this is what I said. Then I went into, if you compare money with non-money assets, then this issue comes, and also within money, various kinds of money, the issue comes of the issue of liquidity. Liquidity is how quickly you can use that. The cash in your pocket is more liquid than the cash in your hostel room, because you have to walk to the hostel room to get the cash. So, the most liquid form of money is the cash in your pocket. The cash in the bank is less liquid than the cash that you have in your hostel room or I have in my house. The cash in the fixed deposit accounts of banks are less liquid than the cash in the savings account, because fixed deposits you have to give a notice, break the fixed deposits, withdraw the money, your money. Cash in shares are less liquid than cash in the bank, because shares you have to go to the broker, dealer, arrange it, resell it at the opportune moment, you have to pay him a commission, etc. So, when you talk about liquidity and utility of money, where you can use it for whatever reasons, whatever requirements you may have, the money liquidity is also associated with something called, what is very popular in economics, called transaction costs. The additional costs one incur to complete an economic function. I have to go to the bank 2 miles away, wait till tomorrow morning 10 o'clock the bank to open, then I can withdraw cash. As opposed to I go to the automatic teller machine next door, they have opened, which they have done for their hostels. Banks have auto and automatic teller machines near your hostels. The purpose is to reduce the transaction cost. You don't have to come to shopping center to use the machine there, or you don't have to wait till tomorrow morning for the bank to open, stand in a queue and withdraw your money, which unfortunately I still do. I prefer transaction costs, so I am not a good economist. Economists would say you reduce transaction costs, because they are unnecessary costs. If you can reduce them, system is more efficient. But I prefer still stand in a queue, not wait till the automatic, go to the automatic teller machine. I still don't have an electronic system. I cannot buy through e-payment, cannot make any purchase. So, a whole lot of problem. Anyway, so transaction costs are common, and you will see liquidity and transaction costs are kind of associated. You have to go to the broker to hand over your shares, arrange an appointment, then the broker takes his time to sell off the shares in the secondary market, hand over the cash to you, and after keeping a commission, huge amount of transaction costs. And transaction costs are not necessarily money cost, that you have to board a metro to go to the bank, or you have to call a rickshaw to go to the bank, which I used to see at IIT Kanpur. Often people do from faraway places. There hardly used to be any cars. So the housewives typically didn't ride cycles, they would get a rickshaw and then go to the shopping center. So not just transaction costs can be non-economic costs. Transaction costs can be, what do you call that, this psychic costs, etc. All right. Then after that, I came to the concept of value of money. The concept of value of money, however, is very different. It essentially talks about the purchasing power of money, how much money can buy. 10,000 rupees today has less value than 10,000 rupees 10 years back. What does it mean? 10,000 rupees can buy fewer goods for me than what 10,000 rupees bought for me 10 years back. Keeping aside the quality issue of goods, I am keeping aside the quality issue. That can be a different story. The simple reason is the same good which cost you some 10 rupees per kg will cost you now 20 rupees per kg. So prices in a country are an essential item from the point of view of the value of money. Because if the prices are going up, value of money is falling. They are inversely related. This has nothing to do with liquidity of money or transaction cost of money or anything. Value of money is simply how much money can buy, purchasing power of money. And value of money do fluctuate, and value of all forms of wealth fluctuates, and they fluctuate unexpectedly. Share prices गिर गया, value of share हो गया, जो हुआ था 2-3 साल पहले. Stockbrokers in trouble, share prices falling. Their price falling, share price falling, and value of shares falling is a positive relationship. Value of money has an inverse relationship with prices of goods. I will come to price of money also. There can be a concept called price of money. I am coming to that. So, purchasing power of money, which is also the real value of money, is essentially the goods that you buy, and therefore a price index is essential to note of. Price index क्या हो रहा है? Macroeconomics, you have studied price indexes. Because price index is a measure of average prices using a statistical approach called index number. So, you use index number methods to measure average prices, typically on the basis of a representative goods. Millions of goods are there in the country. You cannot take prices of all. It will take years to compute the price. You need weekly prices. So, you have a representative prices of representative goods and also representative prices, because price of the same good will cost different amounts. Notice the TV news when petroleum prices go up. In Bombay now it costs this much, in Calcutta it costs this much, in Chennai it costs this much, in Hyderabad, in Bangalore, in Delhi, in Calcutta, and in any other place. Everywhere prices are different. So, you have to take a representative price also, because there is just not one price in the country. This is also a problem. Not that you have millions of goods, but millions of goods have hundreds of prices. My goodness. Literally hundreds of prices you can have. You just travel around the country and ask for the price of 1 kg of rice. Or simply you take a car, Maruti car, that price would change because of various reasons, local taxes, etc., etc. All right. So, the prices have to be, therefore, value of money fluctuates. Similarly, prices of or value of goods, non-money assets, can also fluctuate. Property prices fell means value of property has fallen. So, in wealth, which is a basket, has money and non-money assets, all prices can fluctuate, and therefore the value of these things can fluctuate. But value of money is a very different thing. Value of money is not measured in terms of price of money. Value of money is measured in terms of prices of goods, where they have an inverse relationship. Remember that. Whereas the value of other items are in terms of their prices, directly measured. All right. So, prices, etc. Therefore, you can imagine when demand for money, there was a research going on for demand for money and what will be a stable demand for money function, and people are saying that non-money assets matter in people deciding how much money they would keep. or demand, all these issues came up. Which is a stable non-money asset? Are they unstable non-money asset? Are they unstable non-money assets in terms of value or prices? What would people prefer? To hold the money? Not put it there? Because it's unstable. It's insecure. Your return may not come. You may lose money. Just what happens in the share market. The gain in the share market, in a secondary market, is typically buy an item at a low price, sell it off at a higher price, make capital gain. But suppose you cannot make capital gain, you make capital loss, and repeatedly you make capital loss, you will forget about it. I would rather put my money in savings account, or more safe like a fixed deposit. All right. By the way, I am coming to the rate of the price of money, etc. later. Now, as I told you, therefore, money, non-money, they all determine together how we would demand money. And in macroeconomics, you must have come across transaction demand for money, speculative demand for money, precautionary demand for money. Precautionary demand for money typically is a constant amount, but transaction demand and speculative demand would vary depending upon returns from other forms. You would cut down on your current transaction cost, current transaction amounts or transactions if, for instance, the return from some non-money asset is very high. You rather put it money there and postpone your spending for future. Postpone it to tomorrow or day after tomorrow. If you feel that putting money in a system, in any form of asset like property or something, it can fetch you a lot of income within 5 years, you rather cut back on your transactions now, and transaction demand will go down, and put the money there and make the happy buying for your family 5 years later or for yourself. So, demand for money, which is not usually taught in a macroeconomics undergraduate course, is very much depends upon the return from non-money assets, prices, expected future prices, current prices, all right, of non-money assets, and which determine the return from non-money assets, as to therefore what will be your current kind of expenses in the family. It can happen, all right. Now, having said all these things which you already know from the macro course, the speculative demand, which Keynes called speculative motive, the transaction demand, which Keynes gave a name, probably transaction motive, which however existed from the classical macro model, classical macroeconomics, and precautionary motive, which is, I don't know whether it exists in the classical days, is there, but Keynes did spell out these three motives. There can be three kinds of demand for money, which I need not go into that. You can open a undergraduate textbook, macroeconomics textbook, and you can find them. What I want to get into now in this, what is money, this is the topic that I am teaching, is not only that money has functions, that is why we need money, like medium of exchange, etc. And for medium of exchange to function effectively, we need certain properties of money, or money can be defined like this. I want to take you into the historical development of money, which is very interesting. This is what I call here the kinds of money, and I want to talk about the traditional and the modern systems. So, the subtopic that I would talk about now is kinds of money. Now, you wonder, sir, what do you mean by kinds of money? I actually, this classification of money into kinds, types, is emerging from the historical development of money. Let me tell you the history. This you would enjoy. Let us talk about the traditional system, the traditional money, one group called traditional money. Let us talk about the traditional money. Let us talk about the traditional money. If you look at the traditional money and the forms of money or kinds of money that have evolved over time, you will find there are three kinds of traditional money. The earliest description of money that we have found through archaeological excavations from old kingdoms and empires is that money in the earliest form existed in the form of metallic money, some precious metal, usually gold or silver, in the early days were used to make money acceptable to people. Because it's gold, it's silver. Amazing, human beings were not so civilized, but they knew, they were very conscious about the value of precious metals like gold and silver. So the earliest form of money that you find in the traditional system is the metallic coins. Earliest form you will find metallic coins. And these metallic coins, what we archaeologists have found, money is kept in museum, you can find them. At private collection, there may be few. Earliest form, centuries old, thousands of years. These metallic coins were usually precious metals that they used to use, gold and silver. And how they made it acceptable is through two methods they used. One is a precious metal, so everybody would take it. Why refuse it? Second, they usually have the emperor or empress's signature, not signature, the signature is usually the face, all right, somehow imprinted on it. Amazing. Somehow imprinted on it. So that people would say, oh, ये तो मेरा राजा का चीज़ है. So they accept it. So just not any piece of gold in a round or an oval shape or some shape given. It had a signature on it, and the signature is typically the emperor or empress's portrait, the face. But the problem what became with this metallic money is, these precious metals, they are very difficult to carry, number one, because they are very heavy. So you cannot carry a whole lot of gold in a bag. Second, there is always the fear of theft because it is precious metal. So those days, without a good transport system, etc., you are traveling from one place to another place. Suppose you are a trader and you are carrying metallic coins, theft bhi ho sakta hai. All right? So many of the shipwreck areas, what they look for, these bounty hunters, they look for these metallic coins and metallic whatever, goods. It can be pots and pans, it can be anything, all right. So the two problems emerge from the metallic coins. Practical problem, one, very heavy, so it's not easy to carry. So it's not serving as a medium of exchange, not a very effective medium of exchange. Second, there is always the fear of theft, all right. So what happened over time, these metallic coins gradually which are made from precious metals, were gradually replaced by less precious metals, not so expensive metals, all right, like copper and nickel, still expensive in today's world. When I was growing up, I was even younger than you, I was probably 4 or 5 years old, 6 years old. I remember there used to be nickel coins, and there used to be 1 paisa coin also. So they started making, even in India I am talking about 50 years back, say, or something, nickel coins. So they started using not so expensive metals which are less heavy, easy to carry, more easy to carry, and also the fear of theft is less. So these metallic coins they started making out of copper and nickel. These metallic coins, when they started making copper or nickel, and a money usually has a value, 100 rupees, whatever that name is, yen, mark, pound, dollar, who knows what the name is they used to use. You can find the history of these names in history books. What they found, what they did cleverly was, they made now the face value of that coin, which says 100 rupees, but the copper or nickel content value, the intrinsic value, which we call intrinsic value, less than the face value. So, what used to be the case in the gold and the silver age, that the gold content was equal to, at the current market prices, the face value of the coin. So, the intrinsic value used to measure the face value. Oh, ये gold, अच्छा, you can wait, अच्छा, आज के price में इसका price है 15,000 rupees. That means the intrinsic value is equal to the face value. But now with this nickel and copper replacing it and trying to make it lighter, what they did was, sometimes or many times the face value was printed in order to make it easy to carry the coin, but the intrinsic value became less. All right? This came to be known as token money or symbolic money. The word used to identify this kind of a money where the face value is more than the intrinsic value. Do you think this 100 rupee note, this piece of paper is worth 100 rupees in the market? Symbolic money or token money. The face value, which says 100 rupees, is much more than the intrinsic value. This became the word they used is token money or symbolic money. So, the intrinsic value now differed from the face value. This was the kind of a second stage of development of metallic coins. I will take your questions later. Face value and the token value. Today in India and all other countries, you will find many such metallic coins still in use. In India also we have metallic coins used. 10 rupee coin, the metal maybe, I have been told the metal prices have gone up so much in India, sometimes the intrinsic value turning out to be more. In India ये सब कुछ होता है, more than the face value. So, some dishonest traders or producers are melting that metal, the coins, because they are getting more worth out of it than what they would have been able to get if they have used it as a medium of exchange and doing something out of it. Unbelievable. Acha. Whatever metal, they use steel also in India, aluminium, these are the things they are using in India probably. Some alloy they are creating and making the coins lighter, easy to carry. But the 10 rupee coin is not very light, I have seen. You cannot carry a whole lot of 10 rupee coin. They have made a 10 rupee coin recently, all right. So, I am coming to that. Now, what has happened, I want to tell you something, that over time, the use of coin as a only form of money gradually diminished, because there is another form of money that developed, which is the paper currency. So, what happened was, not only there was a transition from precious metals to less expensive metals to make the coins easy to carry and there is less fear of theft or whatever. What also happened, coins became only a small portion of the total currency in a country, where the larger dominating currency unit has become, even today, paper currency. So, this system which we have is a combination of paper currency and coins, is known as fractional currency system. Fractional currency system, not a one currency system. Then the coins constitute only a small fraction of the total currency. So, what we have now is a fractional currency system. Where coins constitute only a small fraction. You know what the number is? I will give you the number. In India, it's around 1 or 2% only. कुछ है ही नहीं. coins constitute the total value of currency in India. Fractional currency system. Achha. Now, let us go therefore to the next. What happened was the paper currency. How did that develop? Paper currency, how did that develop? That has some stages of development that went through. As I told you, gold and silver coins were not only replaced by inexpensive metallic coins, an important invention was the paper currency. What happened about paper currency, how it developed is very interesting. Initially, paper currency simply carried a promise that it could be converted into coins and precious metals. So, you are traveling from Delhi or Kanpur to Chennai, you want to carry some money, okay? Now, carrying gold, silver or even other metallic coins is a horrendous problem because of the weight, etc., and suppose you are going to spend a month there. So, you are carrying a lot of money. So, then people invented what is called a paper currency, which simply said that issued by somebody, some authority, maybe in the form of a bank or government or whatever, that if you give it to somebody else in Chennai, it promises to give you this amount of actual coins when you reach Chennai. So, paper currency was simply a promise on a piece of paper that you carried. You do not have to carry coins a lot, you carry that safely, all right, maybe it requires your signature or whatever, and when you reach Chennai, you go to the appropriate authority and get it converted into proper currency, which is still coins. So, paper currency came into, in its most original form, came into existence when coins were still the currency, and paper was not a currency, it was simply a promise which can be converted into currency, itself is not a currency. Later what happened, paper currency was made what is known as fiat money or legal tender. Later what happened was paper currency was made, paper itself became currency when it was known as, it became what is known as a fiat money or legal tender. And fiat money or legal tender essentially means, tender means I tender my resignation, I give it to you, I hand over my resignation. Legal tender means legally I hand over this to you when I am buying goods, that means it is a currency, all right. So, it became a legal tender or a fiat money when that paper form was given more sophistication, on which it was written. It was like a decree, a law and an order of the state having the force of a law by the government or the state. As legal tender, what it means is that it must be accepted as payment for any debt that I may have. So, when I am buying goods for you, in monetary economics we look at it as I am having a debt towards you, I am supposed to make you a payment because I am getting these goods from you. And legally, it is legal, not illegal, because it is backed by law, by the government, which is called decreed, and you have to accept it. In order to make it a legal tender, paper currency, when it became currency, not just a promise which I hand over to somebody and get the currency, paper itself became currency. What happened was, if you now look at a coin, not a coin, a paper currency, you will now see what it is written and how it became legal tender. First of all, it is written by on the top, Reserve Bank of India. That means that is the issuer. Like you buy a good where the company name or brand name is written. So, that is the company selling it. So, here Reserve Bank of India is selling it. Underneath in small letters it is written, very interesting. Not only Reserve Bank issues it, but it is guaranteed by the central government, decreed by the government, law. It has the backing of the central government, you cannot deny it. you cannot say I am not going to accept it, because it is issued by Reserve Bank of India, which is a respectable organization. Not only that, it is guaranteed by whatever value is written, 100 rupees, 500 rupees, 1000 rupees, 50 rupees, 20 rupees, 10 rupees. It is guaranteed by the central government. Now, if you open a currency, you will see all these things written. Probably you have never read it, but God knows how many times you have used them. Now, after that, what you will see, look what it promises. Here is the governor's signature, and this note was issued when the governor of Reserve Bank was Y.V. Reddy. His signature is there. And what he says is this: I promise to pay, I promise, Y.V. Reddy is saying as governor of Reserve Bank, I promise to pay the bearer, whoever is holding it, the sum of 100 rupees. That means this is not still currency. It is equal to the value of 100 rupees. So 100 rupees still remains an unknown thing. We don't know. But this can be used to do the transaction worth 100 rupees. So if I give it to you, I give it to Jagdish, then Y.V. Reddy is telling Jagdish, I promise to pay the bearer, who is holding the currency, the sum of 100 rupees. That means he is getting a value worth 100 rupees out of it. Look how it has become legal tender. It was initially just that it promises to get it converted into rupees worth, in gold coins and silver coins, rupees worth something. But no longer that. It itself is a currency now. And the governor of the Reserve Bank, and of course you have the Ashok Stamba, you have Gandhiji's. How can we forget Bapuji? I mean, we made a country, we look around, you will see Bapuji everywhere, of course. But anyway, on the note you have Bapuji and etc., serial number, whatever it is written. Various languages of India used, scripts, Devnagari hai, Bengali hai, Odia hai, many languages. There's some North Indian, various languages, Gujarati hai, various Indian languages. It is written what it is, 100 rupees. You have probably never seen this, but this is what it is written. So now this paper currency initially was not a currency. It was simply a piece of paper promising you to get it converted. But when it became fiat money or legal tender, now one does not require this to be converted into gold coin anymore, or silver coins, or metallic coins to make the transaction. Simply this can be used and people will have to accept it. All right? Okay. And if you open Reserve Bank of India balance sheet, where they report how much currency they have printed and put it in out, and coins they have minted, manufactured. 2006-07 I have notes in circulation 495,938, out of which rupee coins 6626, 1.3% rupee coins, and small coins जो भी है, जो भी था, rupee coin से नीचे तो coin आज और है नहीं, 0.3%. So out of total, our system, currency system now has 6 years old data, 5-6 years. Currency system data is saying about 1.6% coins. So therefore, 98.4% is notes. A fractional system we have now. Is it all right? Okay. Now, when paper currency was getting developed, banks are actually coming into existence, because banks were given the power by the state to handle this. Banks were coming into existence, but original banks didn't deal with paper currency. Original banks dealt with paper which can be converted into currency. So they were like checks. What is it written on checks? IOU. IOU. When you're making a check payment, basically IOU is written. I owe this amount of money to you. Now, paper currency and coins, slowly people realize, are having some common problems which existed historically. They can be stolen still. Easy to carry, so there is a temptation to carry a lot of currency. कितना प्रॉब्लम नहीं है, एक छोटा सूटकेस में आ गया, लेकिन सूटकेस तो चोरी हो सकता है, बस चला गया. This is where the banking system started developing, and it is therefore difficult to transport. With the banking system, what happened, you can have accounts which are called demand deposit accounts, which are checkable. What is demand deposit account? Demand deposit account is my money I have kept in an account which I can withdraw on demand. मैं मांग रहा हूँ उसको वापस. What is the other form of account? Time deposit account, which is as a fixed time, its maturity, its life. I cannot just write a check and say I am withdrawing my money from time deposit. वो time deposit account है, which we call fixed deposits. And demand deposit accounts are savings accounts, checking accounts, etc., where I put my money and I can withdraw it on demand with some restrictions, some minimum balance, number of withdrawal in a month, etc. There are there, but more or less I can withdraw my money. These are called demand deposit accounts. So there develop the demand deposit accounts where I don't have to carry cash, I have to carry the checkbook. When I go to my bank, I can write a check and withdraw the money. It became easier. Banking system started developing, where you can have your money in an account and the bank is the custodian of your money. All you have to do is write a check and withdraw the money, or make a payment through check. Checking system started developing. Checking like system existed the original form of paper currency, where the paper currency you show you get the money. You are not carrying money, and while showing it you require proof, of course, all right, signature, wagara wagara, whatever. So demand deposit accounts started getting created in banking systems, started developing, and not only the banks were developing, or in India for instance it has developed, or in the US it has developed, which are called commercial banks like State Bank of India, but the banking facilities like this also developed in non-banking institutions. Can you give me an example in India where your banking facilities, write a check, withdraw your money, deposit your money, time deposit accounts are there, demand deposit accounts are there, but they are not banks. Post offices, wonderful. Similar organizations are also there in a very old economy like the United States. They also have that. They are not banks. They are like savings organizations. They collect the savings and operate like banks. Many countries may have that. These deposits can be converted into cash on demand for purposes, checkable deposits. Checks are typical IOU type, where IOU, O is an abbreviated word for OWE. That means I am indebted to you. So that's why I am making a payment. I bought some goods. So IOU checks are written to make the transactions. All right. So this is how when banks developed after the paper currency came, and they found still it is very difficult because of the insecurities, the security issues, the transaction costs involved, psychic cost. सारा रात सोए नहीं, रुपया लेके जा रहा है ट्रेन में. मैं तो देखा है, क्योंकि कौन भागेगा रुपया लेके. No, it's true. Then I come to one more thing. We are closing our class soon. There is something which developed. So there are checks, paper currency, and then there are checks, which is a form of money. Like the old paper currency system, checks themselves are not money, but checks can be converted into cash. Like the old paper currency, the initial paper currency thing. Then what I had is something called near money. Under traditional money, we also have checks, paper currency, checks, and you can also have near money. Near money is essentially talking about the liquidity of money. It's not as liquid as money. what we call, and money is, I am talking about now currency only. Near money is not as liquid as money. Say for instance fixed deposit account money, which is near money, okay? Or say mutual funds, where when you put in money in mutual funds, usually there is a lock-in period. There is a lock-in period in mutual fund. For 3 years, you cannot take any money out. After 3 years, you are free to sell it off, like UTI units, SBI, Magnum, whatever. Mutual funds, which are equity linked usually. You put the money and then the organization invests that money in the share market in some proportion. This share, this share, debt equities, whatever. Debt instruments itna, equity instruments itna, whatever. Or government bonds. These are all near money, where there is a transaction cost involved, it's not liquid, it's much less liquid, kind of illiquid, but still it is your money and can become money or currency which you can use, can be used as money, but they are near money, not actual money. You cannot use them overnight. Okay? Kind of what we loosely call invested money, but also fixed deposits come here. Money in fixed deposits cannot be used. You require a week's notice, etc. All right. So I stop today with a discussion up to traditional forms of money.